Privacy.com.
AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I am Tony Mendez.
And I'm Gordon Hines.
This is your drive time real estate special.
Drive time special. And by the way, you said welcome in, should be welcome back. So we're hoping that people are listening today was listening last week and the prior week and the prior week and so on and so on.
And you can always find more information about the show and about what we do at BayAreaLoanSource.com. This is the Real Estate Report. It's your second opinion about real estate. We're trying to empower you through education, information, and participation. It is a call-in show, 800-516-1220, 800-516-1220. Or you can shoot an email to the show, info@BayAreaLoanSource.com. A lot of interesting news out there, Gordon. Rates always seem to be, a topic on everybody's mind. I think there was an analyst from, I think it was CoreLogic or something like that. He was doing a kind of an analysis on affordability. He's saying, as home prices are going up, and in some cases we're seeing stalls. And he was talking about how they fear these interest rate rises because they already think that these stalls are from higher home prices and non-affordable new homes that are coming up. And then you have this fear of interest rate hikes, that a half a point interest rate hike could cause a 14% extra cost in owning a home on a payment-wise.
Wow, it's that much? I haven't calculated it, but it's that much? I wouldn't think it's that much, is it?
It's not that much. It's actually,
Okay.
Yeah, he did it wrong. It's supposed to be 1% equals 12%. 1% interest rate equals 12% higher in your rate, or your payment, that is.
So 0.5% then would
be about 6%.
$7,000.
But it's starting to make sense that you have the low inventory and the buyers who can buy, and hopefully those buyers that can buy are not relying heavily on interest rates, especially after we see what happened to interest rates today, where there was a couple things. The Fed started talking about really starting to ramp. They actually gave us a plan on what they're going to do as far as their backing off of their stimulus. The good news about that is it goes over a long period of time, and 2028, I think, is their project. 2030, it's going to kind of taper off. So, but the news of that kind of sparked a little bit of fear in the bond market. There was a sell-off, and when there's a sell-off, yields go up, and that means interest rates go up. And then, of course, you got Trump. And, Trump's tax plan, they started leaking out, indicating that the actual tax reform may be a little bit different than the actual news that's being released. So the markets were kind of disconnected with another bond sell-off, and that was a little bit overseas as well. And these were the long-term bonds, and these are the ones that affect the mortgage rates.
Yeah, I got a couple of calls today. People asked me, "But Gordon, what do you think of the proposed Trump plan? What would it do for real estate?" I said, well, I haven't seen the exact plan. I kind of went back and looked at what he's proposing so far. I think the major thing that he's proposing is going to a 3-tier tax bracket, kind of simplified the tax code a little bit. I think the good thing for us is, at least I'm happy about it, is it looks like they're not talking about the mortgage deduction. So they seem to be left a mortgage deduction alone, which is kind of right along Trump, because if Trump is a real estate man, why would he want to make any changes to the mortgage deduction, which is one of the main reasons in why people buy homes, in addition to, of course, providing a place to live. One of the great tax advantages of being able to write off taxes and insurance. So he kind of left that alone. They kind of make some changes as far as the contributions, what you can and can't write off, because whatever one thing you do to one side of the equation, you got to do something to the other to kind of balance it. So any tax cut, you have to figure out how are you going to pay for it. So you have to give something or leverage something up to give up the tax cut. So I don't know yet. Not enough information is out about it.
Maybe giving it right to a standard deductions versus
maybe that's one of the things that's leave it alone. Yeah, that's correct. The standard deduction, if you don't itemize your taxes, it's going to be double, which is now that's a significant change, a significant benefit to most people in the marketplace if they're going to double the standard deduction. So
makes you want to go out and have some kids, huh?
Yeah, we'll see how it shakes out. We'll just kind of wait see what the plan goes and see what they're going to give to what we're going to get. See what the end result is. Any change in the tax code is definitely going to see maybe that significant catalyst is what's going to affect our real estate market in the long and short term.
With all that said, rates are still low. Fannie Mae has the Well, rates didn't really change from last week. 3.83%, and these are all for conforming loans, and it started to sound a little bit redundant, but because a lot of people don't have these conforming loans. They're in what they call high balance conforming, or they're in a jumbo, but it is an indication of what the trends are. 3.83%, 3.13% for the 15-year and 5-year ARM is 3.2. All of the rates stayed the same last week, but could end up higher after that long-term bond sell-off. And we didn't see a lot of repercussions yet, but we are looking at probably some rate hikes tomorrow and maybe throughout the rest of the week.
I did see some midday price changes. Actually, I did see across the board. We saw some rates went up 0.25% on some products. So we did see some midday price change based upon that. And tomorrow we'll see you'll see the market go back and recorrect itself, or you'll see the market kind of post a little higher tomorrow. Going into a weekend, it probably will post a little higher to protect itself.
Kind of ignore Fridays. I mean, really, nobody locks on Fridays, and if they do, they lose 3 days. I got a great refinance scenario that kind of came across our table. A client has a primary residence and a rental, and a lot of this has to do again with low rates. As we see more and more low rates, we see equities go up, and some people might be spending money elsewhere. In this case, this person had spent a little bit of money on an equity line 5 years ago. That rate's starting to creep up. Remember, when the Fed increases rates, that affects your equity line rate, and she's getting closer to the recast. That's where that interest, and she's paying interest only, and the interest only goes away, and then it amortizes for the remaining term. In this case, it'd be 20 years, and her payment would spike like $500 or $600. So she's looking to pay that off, lock in some rates, and pay off some credit card debt that she started racking up, between the equity line and that credit card. But she's going to pull out some money out of a rental property, and she watched, and this is down in, where is it, Milpitas, and she's going to pull out some money out of her rental property and pay off the equity line, which is on her primary house, and then she's going to pay off that credit card debt. She's going to save about $800, not including the fact that she's hedging against the future rate hikes and that recasting. So a lot of people are looking at these low rates, and that's why we talk about them as opportunities to manage your mortgage. I think this is a great or a great example of how people manage their mortgage. And I like saying that term because it's not just one piece of property. And if you have two, and I love the whole strategy, Gordon, about using and leveraging that rental property. Meanwhile, somebody else is paying it for you.
Well, I think it's great to be able to reshuffle debt. That's what I call it, reshuffling. I've got a similar scenario that I'm working on right now. There's an older gentleman. He lives in a primary residence in Vallejo. He has a very profitable rental property here in Oakland. He's about to retire, so he's struggling with the payments. He's trying to reduce his costs, which in effect reduces what I call 30-day payout. So one of the things that we're looking at doing, he has a small balance on both mortgages, so he's looking to refinance the rental property, take enough cash out to pay off his primary residence, which is really going to reduce his monthly outgo for his primary residence, and take that additional debt to his rental property. Rates are still low. He'll be able to write off a lot of that interest. So it's a win-win situation. We always tell people, of course, before you do anything, check with your tax accountant, check and see if there's a tax ramification for doing these kind of financial reshuffling of debt. But it's always a good thing to do. You can save money. You can kind of monopolize the opportunity of what you have in front of you with low rates, high equity in the marketplace, and you should be able to definitely get a benefit.
Yeah, it's a great opportunity when these rates are there where they are, and we do these scenarios all the time. You can email your scenario to info@bayarealoansource.com, info@bayarealoansource.com, and we can spit out whatever you're looking for, and we can run many, many, many different options. It's something that I still don't like about the industry is that when you go to a bank and you go, I want a 30-year fix and I want to do this, and they don't even give you options. They don't say, well, why are you doing that? And then and sometimes you end up in a better scenario, and it's just a lack of, that I got in an Uber the other day, and I sat down next to this young lady, and of course, every time I get in Uber, everybody talks about how, home prices are so high because, they're in Uber because they can't afford a car and, that kind of thing. And she started talking about how she works in the loan business. She works for a large bank. I'm not going to name the bank. She works in what they call damage control for this lender. They have 44 branches in the Bay Area, and their originations are at the lowest they've ever been. I didn't tell her who I was, but I did ask some questions. Why do you think that is? Because we're just hard to work with.
Wow.
And you bring up a good point every time we talk about this is most of these large banks are looking for you to be not only a customer as a mortgage, but they want you to deposit money in the bank. And if you don't, unless you already have money there, otherwise they don't listen to you. So but the people that come in and out, she's like, I can't work there anymore. There's just too much work, and there's not enough qualified people to do it. And it's frustrating. She's going to go on her own.
Well, the big banks, I've watched them kind of reshuffle their cards. There I go using that word reshuffle again, and I'm finding that if you are a what they call wealth management customer, that means you've got money in their financial institution, you have stocks and bonds, you have a mortgage, you have a good high credit score, you would get a loan from them at the blink of an eye. If you fall short of that category in which they can't make money off you on another side outside of banking, they kind of leave you alone. I believe they're not interested in that business. It looks like they're interested in the high end, the high debt, the high income, the high net worth type client, and they really don't want to kind of put too much attention on the marginal clients. That's what I see.
Borderline, they do practice one thing that's borderline discrimination.
Financial, is there such thing as financial
This
discrimination?
could be financial discrimination. Let's say, for example, they say, well, if you become a member here and deposit a certain amount of money in our account, we'll give you 0.25% off the rate, or something like that. What about the person who didn't deposit money? So that's going to come up one day. I bet you, Gordon.
Is that financial discrimination, or is that just good business? I don't know. I don't have the answer. Maybe if there's an attorney out here that's listening, can call us and give us his opinion on what that possibly could be, if it is.
There are still some gray areas out there that we just don't have enough time in the day to just go over, and we still have to work on a daily basis. Yeah. With that said, you can call the show 800-516-1220, 800-516-1220. A little bit of news out there, analysis on why some homeowners still can't sell their property, and possibly why inventory continues to shrink about 6% from 1 year ago. So inventory is down 6%. It's negative equity. It's estimated that there's close to 3 million homeowners. They still can't sell their house because they're underwater and would have to pay to get out of their house.
I don't think they're here in California, though.
Not many are in California, and this number is definitely getting better, though. Right now, only 5.4% of all mortgaged properties are in negative equity position, according to CoreLogic, and that's a vast improvement from just 1 year ago, when it was 7.1% of mortgage properties that were in negative equity position. In the past year, homeowners gained $766 billion collectively in equity, which just shows you how much money is still out there to be gained. And we're about $284 billion short before everybody is breaking even. But that's an amazing amount compared to what it was like.
Well, I had a conversation with a realtor last week, and I was asking, what is your biggest question to get over when you're trying to talk a homeowner to selling? And the biggest question is right now, where do I go? When I sell, where do I take my money and go? Now, if you got a plan, of course, if you plan on retiring and more into your ranch down in Idaho, it's probably a great idea. But if you're trying to stay in the Bay Area, stay local with your kids, your family, and your nucleus of your extended family, it's kind of really hard to sell, even though the prices are so far attractive.
There's some stories about that we're going to come up and hit later in the show. Some of the cities in the United States that have the most negative equity: Miami, 14%; Las Vegas, 12.2% of homes are negative; Chicago, 10%; and surprisingly, Washington, D.C., with about 7.2% of homeowners are still underwater. And Washington, D.C. just had a 5% year-over-year decrease in their median home price. I find that interesting. We'll come right back after this break. I'm Tony Mendez. That's Gordon Hines. It's the Real Estate Report.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I am Tony Mendez.
And I'm Gordon Hines.
You can always go to the website, BayAreaLoanSource.com, to get more information on what we do. Gordon, been a broker for 20, how many years?
20 plus. I don't want to
give my
say age away, so 20
well,
plus
you can go
years.
look at his picture online. You can see how many years he's been doing
20 plus years.
There's a little bit of gray and a little salt and pepper.
Well, no.
More pepper.
No, remember, I dye my hair gray so I don't get carded. But anyway.
Okay, I see. You don't drink.
Right.
So what does that matter?
I'm not a drinker, no.
You buying booze for underage people or something?
No. No.
Side job?
No.
Yeah, so we were just, at the end of the segment, we were talking about how equity has been growing and fewer homes that are underwater, and close to 710,000 properties still have less. See, it's not just the people who are underwater. It's the people who are, I can't remember the term that they called it, but it's the people who are right there on the edge, like 5 to 0% equity. So they have equity, but they just don't have enough that they can't pay their realtor enough money to sell the house, or the buyer's agent. And what was the term they used for that? It was a really good one.
I call it. It's a negative equity, negative sale.
Negative sale.
Negative sale, where you sell your house and you have to almost bring money into the table to actually close in order to pay the commission and pay all the expense of sale. And that's where a short sale comes in which you ask the lender to take less than what's owed in order for the bar or the buyer not to walk away less than the seller can't walk no more than $3,000 is what most lenders allow in a short sale situation. Still
something that if you're thinking about doing one of those, and I'm pretty sure that a lot of people who are listening won't even consider it, but if you know someone who is, and the lender tells you, say, well, we don't even consider a short sale until you stop making payments, man, that's criminal. That is just so wrong. I would highly consider talking to a real estate attorney before you stop making payments on your house, just so you can get some sort of, especially the modifications. They told you people with modifications do that as well. So be very careful about that. A side note from this study that came out, half of the available supply of homes for sale in the United States is in the highest third of the market, which is not where demand is the strongest. You can analyze this for quite a while, which there's not a lot of affordable homes. But half of the available supply of homes for sale is in the highest third of the market.
Well, I can see that as every week I'm on the web. I'm an active member of many listings in different areas, and every day I get price postings, and I'm looking at these price postings that come across my desk, and everything is probably averaging over 700,000. The 2-bedroom, 1-bath. Very, very, very few properties in this area here in Alameda, Constitution County. We're seeing in a less than $400,000 price range. So we're in a high end market. I think our market's kind of a really hard market to analyze in a formula type situation because we're unique. But there are many different parts of the country that doesn't have the luxury of what we have, and we have to kind of learn how to work through those formulas.
New home sales fell for the 8th month. Or to an 8-month low in August. The Commerce Department said on Tuesday, new home sales decreased 3.4% last month, the lowest level since December 2016. As the new housing market is softening, so are the shortages. The builders are saying that skilled labor and suitable land for building areas are leading the cause for builders to slow down in their building. Rising prices for building materials are also undercutting housing. And right now there's about 6.1 months of standing inventory for new homes. Now, 6.1 is normal. All right, so there's a lot of people out there arguing whether or not builders should be building more. There was another analyst. I keep reading his stories from Forbes. Okay, he was a Forbes contributor. He said that housing needs to slow down. He based this on some of the pretty interesting stats. Household sizes are not rising, and population growth has slowed down almost by half in the United States over the last couple of years. So when you have those two factored in, is there really a need for more housing? Of course, this is regional. In the Bay Area, for example, it needs more housing. But, it goes to this whole nother story about builders saying that they can't make enough money building affordable housing because it's too pricey. The math doesn't play out. So there's no incentive for them to do it.
Well, I mean, we've talked on the show many times. There's no benefit for building affordable housing unless there's a tax benefit tied to it. The material cost is the same, the labor cost is the same, the sales expense is the same. So if you can build the same house and sell it for $400,000 versus build the same house and sell it for $200,000, of course, there's no incentive for a builder to do that unless there's some tax ramification tied to affordable housing. It's not going to happen.
So this was a great statement, which I think represents the state of the new home building market in the United States, according to Mr. Goodell at the chief economist at Zillow. He says builders say they will not build more affordable homes, but they would like to build more, but can't afford it. The cost of land, labor, materials, and regulatory compliance is just too high. In addition, younger home buyers want to live close to urban areas, not in the far out exurbs where builders' costs are fewer. So we'll come back after this break here on AM.
In other words, that's just what he just said. Builders, affordable housing without a tax credit.
It goes on a little bit more I'd like to talk about, but we'll come back after this break.
2483. This is Money 2.0 on AM 1220 KDOW. I'm going back to my roots another day, another
Welcome back into the Real Estate Report. I am Tony Mendez.
And I'm Gordon Hines. Thank
always-
you for listening.
Yeah, thank you. And we thank everybody for the emails. And in fact, our Facebook page is starting to grow even more. You can go to the Real Estate Report Radio Show. It's our Facebook group, the Real Estate Report Radio Show. And our website, you can sign up for our newsletter that we send out. And Gordon, you have one too.
We've been getting a lot of the website, the email campaign. A lot of people have been calling, asking questions, which is a good thing. I think the first thing that people always ask for, they say, why you always talk rates every week? Because the first thing a person calls when they're buying or want to refinance out, what are the rates?
What's my rate?
What can you do for me? I've seen this rate online. Can you get me this rate? And that's where we have to kind of go into risk-based pricing, LTV, credit score, all that kind of good stuff factors in your actual rate, believe it or not.
Some good news about that. In fact, I just happened to see this article today. Competition is lowering credit standards and profit expectations. Since the fourth quarter of 2016, lenders have increasingly reported to Fannie Mae that they have been loosening their home mortgage credit standards. The company's third quarter 2017 mortgage lending commitment, blah, 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 blah. When asked about their intentions for the next 3 months, they had similar responses, which means they continue to see this competition and are going to move forward with loosening their guidelines. Lenders further eased home mortgage credit standards during the third quarter, continued a trend that started in 2016 in particular. Both net share of lenders reporting an ease on GSE eligible loans. So that's important. That's government standard entity. That's Fannie Mae, Freddie Mac easing their standards. So what that means is that they have Fannie Mae and Freddie Mac have standard, and FHA and VA and USDA and most jumbo loans have standard guidelines. And then when the lender steps in, they're another animal, and they go, oh, we don't want to buy back this loan. We're going to say instead of 2 paychecks, we want 3 paychecks, or we want we can't read this bank statement. We need 5 more bank statements, and that's called an overlay. And it's good news to hear that these lenders, and we work with a lender that's just hitting the whole United States by storm, and they're almost, I don't want to say the word robo, but they are making everything's electronic, and they do a lot of that W-2 and payroll verifications all on their own. So they are taking that away from the borrower, and other lender, and this is the competition we're talking about. And the other lenders are following this, and they're saying, you know what, we can't compete. We're not going to make money unless we do this.
Well, what I've seen over the last couple of months is, I won't say lenders are actually lowering their standards. What I have seen is they're requiring less paperwork. I guess, hence that's lowering your standards. So if you originate a loan, you're going to sell the loan to Fannie Mae or Freddie Mac on the secondary market. There's minimum requirements that Fannie Mae requires in order for that loan to be sellable under their program. What a lender can do, a lender can add an additional overlay or requirement on that, but they can't subtract from it if they want to sell that loan on the secondary market. So a lot of things, what I've been seeing lately is a lot of lenders are getting more aggressive, asking for less paperwork, which I've been preaching for the last 2 years, and I'm finally seeing that now being interjected into the guidelines, which can make these loans close faster. We can actually close the loan now in 15 days, where 4 or 6 months ago we couldn't do it because of all of the paper bureaucracy that we would have to go through. So that's where I'm seeing in the loosening of standards in the consumer market to make the loans more easier to obtain, but still the standards of the debt ratio, the income, the reserve, if necessary, are still there.
All right. Well, I always try to put out some good news, and you kind of said
I kind of qualify the good news.
You kind of qualify. Okay,
yeah,
so I have to qualify everything I say.
Yeah.
Okay. Home price appreciation is beating expectations, according to Case-Shiller's 20-city composite index, showing a 5.9% increase year over year. Seattle, 13.5% year over year. Portland, 7.6%, and Las Vegas, 7.4%. They were leading the pack. David Blitzer, the chairman of the S&P Index Committee, said, while the gains in home prices in recent months have been in the Pacific Northwest, the leadership continues to be a shift among regions and cities across the country. And it's the shift that shuffling. How about that? We can use shuffling again. It's the shuffling of equity and people and jobs all over the United States, and especially in the Northwest. I think the key is that whole reshuffling. I want to talk about Vegas and why that's on the list and what you think about it. We're going to come back after this break on AM 1220. That's Gordon Hines. I'm Tony Mendez. You can always email the show info@BayAreaLoanSource.com or go to our website, BayAreaLoanSource.com. We'll be right back.
Factors not available in all states.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
If you want to get your question on the air, you can call it 800-516-1220, 800-516-1220, or email the show, tony@bayarealoansource.com. Every once in a while, something comes across our desk that we just have to talk about. And this came from Fannie Mae. And the reason we talk about Fannie Mae so much is they do about, between Fannie Mae and Freddie Mac, FHA, they do about 86 to 90% of all the transactions in the United States. And they just put out an alert to lenders that about what they call a reverse occupancy. It's when a borrower buys a home as an investment property and lists rents to offset that debt. But instead of renting the home, the borrower occupies the home as a primary residence. They're saying that this is fraud, and they're making lenders aware that they are going to step up their game on this. So be really careful about your intent to occupy this property, because there is something called MERS, Mortgage Electronic Registration System, and they basically have had it for years, and they can track what kind of transaction you did. So be really careful when you are presenting this to your lender, and if you are going to try fraud, they're going to catch you.
Yeah, there's certain red flags I think lenders look for. They look at mailing addresses is all the thing, where you have your mail going. The second thing, what type of insurance, if you bought a homeowner's policy versus a landlord's policy. There's all kinds
What's
of
the mailing address?
red flags that lender typically can look at to kind of tell what a person can. The thing that I can say is they can never nail you for what happens long term. But if it's a plan, if you had no intentions of actually renting that property, you clearly bought that property on the occupancy, I think then you might be a little bit off base is how you actually got that loan, and that could be conceived as mortgage fraud.
So they're always stepping up their game, with no surprise, of course. They are making money though, and this is the reason rates are low. It's because Fannie Mae has stepped up their game, and they set the standards, and they're able to sell these mortgage-backed securities at a AAA rating, and you're getting the best rates. All right, that's why. So you can't kind of bite the hand that feeds you here. So you just got to follow the rules. That's kind of the whole theme since we got out of this mortgage mess. A little bit more news. Month-over-month home price increases is slowing down. So this acceleration is slowing down, according to Black Knight Financial Services. One analyst at CoreLogic, he pointed out that in Southern California, they're seeing a stall right now in their median home prices, hovering around 500,000. We talked earlier about how even Washington, D.C., a hot market of late, they saw a 5% decrease in their median home price from a prior year. The analyst also stated that the home price increase, which, by the way, was on an 8% tear month over month, okay, year over year, month over month. You guys know what I mean. It understates the rise in cost for home ownership. Not only are home prices rising, but the fear of rates rising. I think he's wrong on this. With the 0.5% interest rate increase would add 14% to your mortgage payment. It's really half of that. But you have these interest rate fears that rates can go up, especially when the Fed's talking about raising their interest rates because we have a better economy, which can warrant higher interest rates, and that's going to start costing you money. Yet at the same time, the down payment. The down payment in the United States, the average down payment for a purchase is only 6%. And it's been 6% for about 3 straight years. 2/3 of the respondents, according to Lawrence Yun, who's from the National Association of Realtors, he says that rents and home prices outpaced incomes in the past few years, and this is undoubtedly impacting their ability to put aside savings for a home purchase, even if they increasingly believe it's a good time to buy. Which there is another nice little article here that home sales might be a bit disappointing, but the National Association of Realtors says consumer attitudes about the economy are not the reason why. And they found increasing confidence among respondents about the direction of the national economy and their own finances. So we have higher, and a lot of that has to do with higher home prices. People have more equity. They feel more confident in spending money, hoping that someday, in the worst case scenario, they can tap in that equity.
Well, if you talk to most homeowners, believe it or not, and in addition to creating a great house, as we just talked about an example where you told me your brother was showing a property to a prospective buyer, and the prospective buyer wanted to know, hey, what's my return on investment in this area has been for the last year? Most people, when you look at buying houses, are always interested in, hey, what is this thing going to be worth in a year's time? I mean, it's great to be live in a great house and a great freedom of occupancy, but that's one of the most underlying factors in talking to a lot of buyers. Hey, appreciation. How much money am I going to make? That's what's happening in the marketplace.
It's the
right now.
same reason why we get people calling the mortgage people, and they go, "What's our interest rate?" It's the same thing when you buy a house. What's the drive, Gordon, behind much of the buyers now? I'm hearing more about just get the property, no matter what. Prices and rates will eventually rise. Let's lock it in now. Do you kind of feel that sense again?
Yeah, a lot of people believe that the market's going to continue to go up. And I was telling an investor yesterday that, I'm an investor myself, and there are a few deals that I passed on. And now, being Monday morning quarterback, looking back at those deals, I made a bad decision because I thought those deals were too high priced. And now I've seen what another investor have bought and resold the property for, and where that market's gone. And I'm saying, boy, did I make a mistake on my expectations. But in a high increase expectation market, everybody expects everything to go up because things are good. When things start to go sour a little bit, then the whole mindset changes. That's the consensus I get from people in the marketplace today.
Do you think that Southern California or the numbers that we saw from Southern California, where the home prices are stalling, or the median home price is stalling, we have Washington D.C. seeing a year-over-year decrease of 5% on their median home price. Do you think those are kind of stress cracks that we're seeing in just pieces of the market? Do you think that's going to feed out to other markets?
Well, that's what if you go back and look at history, that's where it typically starts. I mean, if right now the average, what we talk about in appraisal is DOM, days on the market. If the average of days on the market for a property today is 15 days, and in 6 months the average is DOM in the market is 30 days, that tells you the market is slowing down. So there's some catalyst that's causing that market to slow down. The run up of prices could be a natural slowdown because the prices can only run but so high, because if it runs any higher, there's no affordability factor. So it could be a natural progression, but it's a sign that things are going to change. And once again, we do need change to have a healthy market. Things can't continue to go up. Sometimes things it's like the weather. You got to have some sunny days, some balmy days to really make you appreciate those sunny days, right?
No, I totally agree. If these are opinions, of course, and I like California real estate. I like Western real estate, but what I like more are the secondary cities, the Sacramentos, the Renos, the Las Vegas. What's your opinion on Las Vegas right now? We're seeing almost double-digit year over year. Is this still going to drive it? We got a football team going there now.
Well, I was in Las Vegas early in the month, and I'm seeing come along that 215. Housing tracks are going up left and right. With the football team coming, the economy that's a sign that people are moving there.
Yeah. It's also a sign that there's more land to build.
There's a lot more land to build in Las Vegas because it's a metropolis, a spread out desert.
All right, we'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report. You can always call the show, 800-516-1220, or email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com.
Under the California Residential Mortgage Lending Act. Rates and programs are subject to change. Classic Home Loans, Lafayette, California, NMLS number 242483.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
Gordon Hines.
You can always go to our website, BayAreaLoanSource.com. I love this story. McDonald's sales are rising where marijuana is legal. Don't know why I thought I'd put that in there.
Yeah, I can tell.
Yeah.
People get the munchies when they smoke marijuana, so they're girl McDonald's sales.
Because that might be a side.
They go to the dollar menu.
Yeah.
After you spend all your money on weed, right?
I suppose so.
Okay.
It's expensive. I mean, not that I'm out there buying it, but I've heard it's very expensive. Not McDonald's. I'm talking about
everything is
green
expensive. Speaking of expensive, our buddy Hugh Hefner passed this week. So
Yeah.
so he raised the price of everything in Hugh Hefner.
Yeah, very controversial though. You can always email the show, Tony@BayAreaLoanSource.com or info@BayAreaLoanSource.com. We got an email from Harmon in Milpitas. He bought a house in Tahoe in 2005. Gordon, you're going to love this email. You're going to have to tell me what you think. In 2005, as a second home, I want to turn it into a rental property, refinance it, take cash out, fix it up, and then use the remaining funds to buy a different second home. So I guess what he's trying to do is take some of the equity and buy another second home. Why won't the lender allow me to use the rents to offset the debt on the refinance? So he wants to turn it into a rental, and I guess the lender is saying that they won't allow him to use the rents. What are my options? So Fannie Mae guidelines are pretty specific on this. If you want to buy a house, if you buy a rental property in between tax filings, you can use a lease agreement with 75% of the rents. But if you own the property beyond that one tax year, so you've already reported the property, in this case he's had it since 2005 as a vacation or second home, He's been reporting it on his tax returns. He can't just jump in there and give a lease and then use the rent. So that's according to Fannie Mae. So we were just talking earlier about how lenders are kind of loosening their view on the overlays that they're putting on top of Fannie Mae guidelines, and this is kind of loosely interpreted by lenders and brokers. Large banks, they're not going to touch this. Okay, but there are some wholesale lenders and some portfolio jump all over this, and they'll say, sure, you'll get a higher rate, but you'll get the money, and then maybe you refinance that after you get a lease in there. So there are some options for Harmon and Milpitas on the second home conversion into a rental property. But what do you think about that?
I don't. It's a challenge, but I think if everything properly documented, it can actually make sense. So if you look at a second home, there's no income coming in, so you're actually hit for two debts: one on your primary residence and one on your second home, assuming there's a mortgage on the second home. So if you have the mortgage on the second home,
he's trying to take some money out.
He's trying to convert that second home into a rental property, where he doesn't have a history of rental property income on that property. So I'd have to look at the guidelines closely and see, does the receipt of a rental agreement, monies, if he goes to a property management company to legitimize it even more, show the money's coming, show the contract from the property management company, show the first and last deposit. I think he might have a shot at trying to really sell that position to a lender, saying, hey, listen, this property is now a bona fide rental. I should be able to use the rental rule if I'm disembarking from my primary residence and get to 75% credit with the rents to help offset that debt.
If that doesn't work, maybe rent it for a year, and then, or at least file it. Right now it's October, or will be, and you just maybe get a renter in there, and as soon as you file, you show the income, and that is a rental. That could be another short-term way around that. So there are some options, but these are the type of things that, we work with several lenders that would look at the scenario. We look at the scenario, we read the guidelines, and we try making sense. These are scenarios that we love hearing from people. You can always email us these scenarios at info@bayarealoansource.com, or you can just email us directly, Tony@bayarealoansource.com, or Gordon@bayarealoansource.com. So quite a bit of news out there. I wanted to hit some of these, America's top 20 hottest markets for real estate. These are basically internet searches. San Jose, San Francisco, Vallejo. Here's interesting. Stockton's number 6. They lost the point. And I wanted to also hit some of the 7 biggest mortgage mistakes to avoid. I guess these are some things that maybe at some point we'll go over on our
podcast,
on our Facebook Live that we do after the show. Maybe we'll do the 7 biggest mortgage mistakes after the show, and we'll do a Facebook Live. Go to the Facebook Live by going to the Real Estate Report radio show at Facebook. Real Estate Report radio.